We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lyn Alden, founder of Lyn Alden Investment Strategy. How are you today, Lyn?
Good. How are you?
Excellent. Good to have you back. I know it's been a little while and our listeners always enjoy hearing from you. So it's going to be good to have another discussion and give us a little bit more clarity on how things have really progressed. Obviously, I want to kind of focus on inflation here. And that was, a real focus of your most recent newsletter on the dilemma of the Fed and its dichotomy of trying to fight inflation while also not creating a recession. So while we had QE or growth in money supply in the years before the pandemic, why was it hard for central banks to get to their inflation targets?
Well, it's funny how their targets work because basically they're saying that they're not debasing your currency fast enough and that they want to increase that rate, right? So that's something that they were doing for a number of years. And basically what you had back then was a period of commodity oversupply. And so in North America, we ramped up shale oil production rather quickly. Mm-hmm. And that was supported by, low interest rates, as well as investors that were willing to keep investing into something that was free cash flow negative for the most part. And so in aggregate, that industry was not free cash flow positive. They were relying on issuing debt and equity to investors. And for a long time, they were happy to fund that. And so we had this period of oversupply, at the same time as we had slowdowns in emerging markets, especially when the dollar strengthened after QE3 ended. And so you had this period of time where demand was a little bit weaker than people expected. Supply was more than people expected. And so we had commodity overabundance. And that happens in the long-term commodity cycle that we go through globally. And so that kind of hit its crescendo with negative oil prices during the COVID lockdowns. That was kind of the second washout for that space. And then when you combined the currency, the amount of currency that was created from fiscal stimulus primarily, as well as holding rates below inflation, doing a lot of QE to monetize the debt issuance associated with that fiscal spending. They basically reinflated demand at a time when a number of supply, a certain amount of supply was taken offline. And so now that we have more commodity scarcity, right, from years of underinvestment due to low prices, as well as an uptick in demand back to prior levels, this is a very different environment than what they had, over the past 5 years or so.
Mm-hmm. So should the Fed have maybe been in a more defensive or resilient position in 2018 and 2019 with interest rates needing to be higher than they were?
Well, they certainly tried. I mean, they were raising rates and, the famous Powell pivot, a lot of people looked at the 20% down in the S&P 500 and assumed that's why he pivoted. But I think, for people that are looking at the nuance, I think it was the credit markets that led him to pivot. And so there is that period, about 6-week long period in late 2018, where no junk bonds were issued, for example. Credit markets basically slammed closed on them. And that's a much more acute problem for the economy than S&P 500 going down 20%, especially from rather elevated levels. And so they tried to raise rates until they basically were told by the market that we're going to freeze up and go into recession if you keep trying to raise it. And so they eventually stopped raising rates. Then they were still trying to taper their balance sheet down, and then they got the repo rate spike. Mm-hmm. And so interbank lending markets broke, and basically, there are too many T-bills relative to reserves in the system. There are all sorts of reasons for that. They had to start monetizing debt. They had to start taking T-bills off the market. And so there were not a lot of options if you were the Fed. Now, I think there were options decades ago. I think there were, under Greenspan, I think there were certainly options. I think they could have, had a tighter thing going into this whole environment. But after the global financial crisis, and then, during that whole rate hiking cycle and balance sheet reduction cycle in 2017, 2018, and into 2019, that was basically a period where there's only so much they could do by that point. They had already kind of backed themselves into that corner.
Mm-hmm. So Lyn, I guess the logical place that my mind goes as hearing you explain that is, where does it all end? I mean, there's a crazy amount of debt in the system right now. Is the most likely path to just inflate it away?
I think that's the most mathematically likely path. Yes. I mean, basically, studies show that when countries get this indebted historically, they have like a 98% default rate. There's like a study by Hirschman Capital, I believe it was a couple of years ago. And generally, when you get over 130% debt to GDP, there's really no way to recover from that level without basically defaulting in some way. Now, that default can take numerous forms. If you're in an emerging market and you owe dollars, you can't print dollars. And so defaults are likely to take place as actual defaults, restructurings, basically saying we can't pay 100% of it. Maybe we can do half of it. Let's figure out how to do a haircut here. Of course, the other option is if the liabilities are in a currency that you print. If you're a developed market and you're, if you're in the United States and they're denominated in dollars, or if you're in Canada and they're denominated in Canadian dollars, then generally they default through inflation, where they don't actually default. You get paid back every unit of currency you're promised, but those are worth maybe a third less or a half less than they were maybe at the start of that decade. Mm-hmm. And the only other time the United States had this much debt to GDP was during World War II, and that's exactly what they did. They held interest rates at near zero. They pegged the long end of the yield curve below 2.5%, and you had very high inflation. They even had, at one point, they had 19% year-over-year inflation, and they were holding rates at zero. And so if you were holding treasuries, you lost something like 40% of your capital from the early 40s to the early 50s. And I think that certainly could be what we're seeing going forward. I mean, pretty much ever since the global financial crisis, rates have been negative in real terms, right? So they've been holding rates at zero while inflation was some low positive number. And then there's a brief period where they hiked. Technically, the federal funds rate was slightly above official CPI, but that was, one, it's, relying on the accuracy of CPI, and two, that was a very brief period. But for the most part, they've been below the inflation rate, and of course, that really accelerated, kind of post-COVID stimulus.
Mm-hmm. So is that a big reason why you compare our current environment to the 1940s a lot?
Yeah, that's basically the culmination of the long-term debt cycle based on Ray Dalio's work, and I've kind of looked at the data independently and come to similar conclusions based on the inspiration from his work. And basically, what that does, so this whole system that we've built, this whole credit-based system, this fiat-based system, is basically based on the premise that debt as a percentage of GDP keeps going up. That's what fuels all this, part of the growth that we have, and that works as long as interest rates keep going down. And so from, say, the 80s to the present, you had interest rates going structurally down, even as debt as a percentage of GDP went structurally up. And so your interest payments never really went up as a percentage of GDP, as a percentage of disposable income. So it wasn't really harder to support that debt. It's kind of like how if you have a house, you get a mortgage on it. If the house, if you're buying a house today, it might be twice as expensive as it was decades ago, but the mortgage rate might be half of what it was, especially before this recent increase in mortgage rates. And so that makes it, relatively easy to afford the same house, despite the fact that you've had, maybe higher house and higher mortgage to rate to income ratios. Same thing for government, same thing for corporations. And so the problem happens, of course, when you run into the zero bound, or even slightly negative in Europe's case, where you basically get to a point where you cannot raise interest rates any lower. You start turning to fiscal stimulus whenever there's recessions. And then at the point where interest rates go flat to up, it gets harder and harder to service those debts when debt as a percentage of GDP is that high. And so they basically turn to the same thing they did in the 40s. And it's kind of what we're seeing now, where you have inflation officially of over 8%, and they're raising rates from zero at 25 or 50 basis points a time, multiple weeks apart, and kind of lagging that inflation by quite a bit. And I think that's pretty much by design, because they know, if they just came out and said, "Hey, we're gonna bring rates up to 9% tomorrow," you'd have an epic crash, right? So because there's so much debt in the system, pretty much everybody would be insolvent at those types of interest rates. And so they're kind of hoping that these marginal increases, this marginal tightening, is enough to do it. And I don't think it will be ultimately, but I think that's the environment we're in, where we're going to have persistently negative real rates. Now, there could be periods of time, like very brief periods of time, where you have some sort of deflationary bust, and then you briefly have positive real rates. But I think for the most part, just kind of like looking back over the past decade, I think looking back at the end of this decade, we're going to be on average in negative real rate territory.
Mm-hmm. So When we think about the deflationary forces and how threatened central banks are by, these deflationary busts, like you just said, are there both good and bad examples of deflation that we can see in the world?
Well, good deflation is from technology and productivity increases. Basically, over time, the long arc of history is that, especially in the past 200 to 300 years, we've tapped into these denser energy sources, and basically, we don't really realize it, but the amount of energy we consume, we basically have like a dozen humans working for us every day in terms of energy output, right? So, the amount of energy it takes to power your house and run your car and build a lot of the electronics and other things used on a daily basis, that takes multiple humans worth of energy kind of working for you all the time. That's the equivalent of what people in developed markets have. And so combined with what we've seen in electronics in particular and other areas, there's good types of deflation. I mean, in a low debt environment, deflation is what we want. We want things to get cheaper over time as a result of us being able to more efficiently make them. And so that's the good type of deflation. The bad type of deflation is when you basically have a debt bubble, and that debt bubble starts to collapse. And so you basically collapse in demand. And then you get, basically you're left with oversupply. That's kind of what we had over the past decade, where you build up new supply, and then you had a reduction in demand, and then you're left with, this oversupply. And so that's kind of a bad type of deflation, especially because that generally results in high unemployment and just recessionary economic conditions in general. And I think that, a lot of modern economists will view deflation as always bad, but that's because they're looking at it through this lens of constant credit expansion, constant debt expansion, fiat systems. That's kind of based on the premise that they want low and positive inflation and constant debt increases. But in other systems, deflation would be a good thing.
Mm-hmm. So the Fed is hoping to engineer a soft landing for the markets here. But if we have too strong of a deflationary shock or multiple shocks, could that lead to a much worse outcome if we start to see a cycle of defaults accelerate? And if that starts to happen, could that be the trigger for the Fed to reverse course?
I think so. I mean, soft landings are historically pretty rare. If you look back at the number of Fed tightening cycles over the past, 50, 60, 70 years, their ability to engineer quote unquote soft landings is pretty low. There might have been a couple cases where you can kind of call it one of those, but for the most part, you just get recession. I think the best they can hope for maybe is a mild recession, because the problem, of course, and I've said this a number of times, is that the Fed can't print oil, they can't print chips, they can't print copper, they can't print houses. And so I think this is only resolved with the, bring online new energy sources, bring online new manufacturing, shipping capacity, and that takes time, and that takes capital, and that takes aligned incentives. And so right now, for example, oil futures priced out 3, 4, 5 years are actually pretty cheap. The market still thinks a lot of this is transitory. And so if you're an energy producer, are you going to want to ramp up production a ton right now when basically you're being told that your old industry, you're being phased out? This is just transitory. Future prices are lower. And if, by the way, if you are too profitable, we're going to do windfall taxes, right? So does a lot of new capital want to go in there right now? Around the margins, obviously energy prices are pretty high. There's some expansion happening, but it's not as though there's a flood of new supply coming online in any sort of timeline that we can see in the next 6-12 months. And so I think that they're going to, they can reduce inflation for periods of time if they control demand enough. But I think in order to return to an environment of disinflationary growth, basically growth without very high inflation, you would need to improve the supply side. And that's just not really in the cards right now.
And I'd like to get to a lot of the problems surrounding the energy, but I'd like to finish up a couple more things with the Fed here, basically. If they keep raising rates to, let's say, 3, 4, or 5%, what would happen to the dollar and by extension, the countries that have a lot of dollar denominated debt in that scenario?
So that partially depends on what's happening with other currencies. So some of the stronger emerging markets have front run the Fed. And so they started raising rates, well over a year ago. Many of them have positive real rates, actually, way higher than the Fed. and some of them have a lot of reserves relative to how much, say, external liabilities they have. And so I think those would weather it pretty well. I mean, they would have to tighten. That can put themselves into a recession, but I think they can get through that. I think the problem areas are ones where their external liabilities exceed their reserves. An example would be Turkey. And ones that are not raising rates to basically attract foreign capital, above their level of interest, above their level of inflation, and so it makes their currency undesirable. Again, Turkey is an example of this, but there are others, and so I do think this is a dangerous environment for a number of those weaker emerging markets that don't have the reserves or the positive real rates to basically become a carry trade. And then as for the dollar itself, I mean, you're comparing it to Europe and Japan and these other major currencies. I think that the dollar is going to strengthen, or at least be neutral relative to them, especially if they continue this hiking cycle. But that it's not necessarily going to strengthen compared to the strongest currencies out there, the ones with the huge current account surpluses, the ones with positive real rates, or at least less negative real rates. So I think it's something you have to look at on a currency by currency basis. But certainly one of the biggest factors in global macro is the dollar. It's very hard for the world and even the U.S. to grow while the dollar is strengthening, because basically what it's doing is it's kind of like quantitative tightening the whole world. The unit of account that the majority of the world uses for its external debt liabilities is strengthening relative to a lot of other currencies, and so you get this kind of like tightening dynamic. And that also means generally that in strong dollar environments, the foreign sector doesn't buy that many treasuries, and that actually ends up in large part being the trigger that causes the Fed to eventually reverse, because if the foreign sector is not buying a lot of the treasuries, it means domestic sources have to buy more of them, which means they're not buying as many stocks, and so basically you get a crowding out effect, and eventually what happens is the Fed has to come in and be dovish in some way. Now they could, for example, buy treasuries themselves. They could also do things like adjust the SLR rules for banks to allow banks to buy more. And I think that's one of those things. It's not on the cards for the next couple months, because there's not a lot of expected treasury issuance at the current moment. But I think the longer this extends, the more treasury market illiquidity and lack of demand could be a problem for them.
Right. So, Lyn, is that by, in some ways by extension, does that mean that the Fed's actions right now are really the biggest driver of where the markets are heading all around the world?
I think the Fed is certainly one of the biggest drivers. I think obviously what's happening with energy capex and geopolitical issues, Russia's war, I think those are also very large factors, but certainly the Fed is one of the biggest, because they have a large control of the main unit of account that is used not just in the US, but globally. And so that's going to be a big factor. And the issue is that most central banks, including the Fed, are basically backward-looking institutions. They don't generally have a good history of forward projecting that's accurate, and so they're usually chasing whatever is happening lately. And so right now, with official CPI as high as it is and official unemployment as low as it is, they have a clear mandate to try to, decrease inflation, even if it means mildly increasing unemployment. But of course, it's very hard to do that in moderation without causing that momentum shift, because job losses means that people can consume less, which means businesses don't do as well, which means they hire less, which means there's more people that aren't able to consume as much, and so you get that negative feedback cycle. That is it's hard to say increase unemployment from 3% to 5% and stop there, right? That's historically a very challenging thing to do, and so I think right now they're clearly going from one direction to the other. But the problem is, I think we're later in this cycle than they realize, and so we have declining PMI, so declining Purchasing Managers Index, which basically means economic deceleration, even though it's not necessarily outright recession yet. You have very, very low consumer sentiment, and so I think that these are going to be challenging for the next 6 to 12 months, and it's a very difficult environment for them to try to be hawkish in.
Yeah, and it's kind of like I've heard you say in the past, it's more like a light switch than a dial that they can control inflation and all these other factors that you just mentioned, right?
Yeah, and that's something that Luke Groman brought up a number of times, and I agree with him on, that basically that the Fed still thinks this is like a dial that they can control, whereas there's so much debt in the system, It's kind of like you're either growing or collapsing. It's really like that kind of Boolean, that light switch outcome. And so I think right now the light switch is off, and so it's very hard for asset prices, for unemployment levels, and for consumer sentiment to do well in this type of environment.
Mhm. So, as the pandemic showed the world just how fragile supply chains and the just in time inventory model is, it seems like the deglobalization theme is now spreading around the world. So, will this be an inflationary force as countries need to rebuild domestic manufacturing and very likely face higher labor costs as well?
That's my expectation, at least around the margins. And so, of course, deglobalization does not mean we just stop globalizing, right? We don't just end all globalization, but it means we can stop increasing globalization and maybe pull some of it back. So one simple way to measure it is global trade as a percentage of global GDP. And so, that was rising throughout the 1800s. Then, of course, between World War I and World War II, that was on this lengthy contraction period. It never went to zero, but of course, it started going down. After the resolution of World War II, it went up pretty significantly, and then especially accelerated in the the 90s and thereafter, because you had the opening of China, and then you had the collapse of the Soviet Union, which brought a number of Eastern European and Central Asian countries to the broader markets. And so basically, there was this big untapped pool of labor. And so a lot of companies around the world did geographic arbitrage. They said, okay, well, we can pay these people 50 cents an hour and eventually increase it to $1 an hour and $1.50 an hour as they get more developed to make things for us. And that even when you ship it across the world, it ends up being cheaper than paying someone, $15 an hour in the US. And so that was a very disinflationary force combined with, modern electronics and software. The problem is that's not permanent, right? That can only persist so long. Eventually, those markets get quite developed. So right now, China has become more developed, and also, of course, there's this brewing Cold War between the United States and China. They're more economic rivals at this point, and it hollows out the U.S. industrial base so much that you start to get rising populism and political challenges back home. And in other countries that did this, because not every developed country outsourced their supply chain the way that the United States did. They still make stuff in Japan. They still make stuff in Germany, for example. Italy has a current account surplus despite its other problems. They actually have a decent manufacturing base in the northern part of the country. And of course, in the United States, we do make some things, but as a whole, we run this structural trade deficit that's starting to become a political problem. And so I do think we've kind of run this course. COVID kind of put the final nail in the coffin there when it became more of a national security issue about your ability to get ventilators, ability to get masks, basically ability to make things you need. Right now, for example, we have a shortage of medical dyes in the United States because they're like almost 100% of them are made in China. And they've had these severe lockdowns. And that basically means that people have trouble getting an MRI or other sort of digital scans because these components we don't even think of are made on the other side of the world and have logistic problems. And so I do think that we're entering a period where either globalization is going to stop going up, defined as trade as a percentage of GDP, especially ex oil, or it could even start going down to some extent. You could pull back some of that. And so that should be more inflationary overall because you're not doing that geographic arbitrage anymore. Basically, historically, money supply and inflation are very correlated, but you can have periods where you have bigger gaps than normal. We increase money supply and CPI doesn't go up as much as you expect because you have some sort of massive abundance. And for example, in the 1800s, late 1800s in the United States, you had this whole continent of resources and land, and basically you had a very abundant resources, lots of immigration, so you had lots of cheap labor, and it basically made it so that you didn't have as much inflation as you'd expect from the amount of money supply growth during that time. You had a similar period in the 90s and the 2000s where you had kind of this unusually large amount of disinflation compared to the amount of new money creation. Because you're basically tapping into this huge pool of resources. And I think overall that pool is a lot more shallow now today.
So Lyn, much of the East, as you were just mentioning, but China especially, let's say, became very specialized in manufacturing goods for the rest of the world during this age of globalization. So How do you see, let's say, their GDP suffering of these export heavy countries as this deglobalization really starts to unfold? How does China really make a transition to becoming less of a export heavy country?
So China, I think, is going to slow down overall. We're already seeing that in the data. I think it's going to be more structural. Their way to pivot, and it's very hard. This is a very hard thing to pivot. It's the middle income trap, where you develop up to a higher level, and then you're no longer a source of cheap manufacturing, or at least as cheap as you were, but you're not quite enough to be advanced, super high tech industries. Now, and China has a better chance than most of navigating that transition because of its size and some of the other factors there. But basically, what they have to do, and I'm not sure they're going to be able to do it, but I think they're going to try, is to shift a little bit more consumer oriented. And so, for example, if we look at the United States, 100 years ago, we were a export powerhouse. We were the rising power. The UK was the one running the structural trade deficits with us, and we were supplying, the rest of the developed world with goods. We were kind of this rising emerging market, and of course, eventually we shifted towards a more consumer-oriented market. And I think, of course, we went too far in that. We became too consumer-oriented. And I think China, right now they have one of the lowest levels of consumption relative to their GDP. They're very oriented towards that export industrial base. And I think, the transition is for them to consume more of their own production, which basically, is generally necessitates policies of stronger currency and more consumer-oriented types of reforms. But I think the challenge there is that, that doesn't work well with kind of government mandates, right? If you give the consumer more power, it reduces the relative share of government power. And so I think it'll be a challenging one for them to navigate politically, but that is the right answer for them to do, which is basically just become a more balanced economy.
So on the other side of that coin, Lyn, as we think about the current challenges of Europe, not only from an energy standpoint, how do they face a unique set of challenges of having a monetary union without a fiscal union?
Well, I think in the long run, they have to pick one. They either have to have more of a fiscal union to match the fact that they have a monetary union, or they risk the monetary union breaking up, or maybe splitting in two or splitting in three, maybe certain countries leaving, other countries staying. And I don't know yet how that's going to work out, because that is dependent on human decisions. But for example, in the United States, each state has a similar problem to a European country, where they have to, they can't print their own currency. They have to run their own books. The difference is that in the US, we mostly have a fiscal union. So most of the big budget items, defense, Social Security, Medicare, are off of the state balance sheets. They still have to deal with Medicaid and, of course, their own state level things. But for example, the typical state in the US has a debt to GDP level below 10% on the state level. Most of that debt is instead on the federal level or on private households and corporations. It's not really concentrated on the state level. And so there's not that many states that need, monetization by the central bank in order to remain solvent. They eventually might run into pension issues and things like that, but they're far less structural issues. Whereas over in Europe, you have countries with 150% debt to GDP, like Italy, where there's no interest by foreign sector in buying their bonds. And so they're reliant on ECB monetization. And there's really no, right now, good solution for that. They can't say out loud, we're just going to have to keep monetizing. But they also, if they say, hey, we're going to stop supporting that, then, well, you can have a debt blow up, sovereign debt blow up in, multiple Southern European countries. And it kind of comes down to what Europeans want. Do they want more of a fiscal union, or do they want to partially split up again? And I think it remains to be seen, at least to me, which direction they're going to go in. But I think that the current situation is clearly unsustainable.
That actually reminds me, I was looking through your Twitter feed, and you said, how will the ECB get its balance sheet down? And the answer was, it will come. It will come in due course. It will come. And you said, how? Well, in due course, it will come. There's the mechanics of it are all challenges on all sides, right?
Yeah, that cites an interview that Christine Lagarde did, and she was asked point blank, "How, are you going to get the balance sheet down?" And she said, "Well, yeah, in due course it'll come." And they were asked how, and she basically had no answer, because she knows that structurally they can't get it down. And instead of just saying, we're not going to get it down, we believe that the current reserve levels are adequate, whatever word they want to use, instead she was saying that it's going to come, but then couldn't give an answer as to how, because realistically, it's not going to come down. Mm-hmm. Now, maybe for a couple quarters at a time, kind of like how the Fed was able to reduce its balance sheet for a period of time before they had to start increasing it again. The ECB could potentially have a phase like that, but structurally it can't come down because there's just no demand for sovereign bonds at deeply negative real rates by the foreign sector. And the only source of demand for that is the central banks that have like a political mandate to kind of grease the wheels there. Because when you have 150% debt to GDP, you can't offer positive real rates on that structurally. They have to default in some way. And the mildest form of default is just have deeply negative real yields and have the central bank keep buying them. And so, of course, that creates problems for anyone who is mandated to hold those bonds. It causes problems for inflation, economic stagnation, but that's currently the path they're on.
Right. So, Lyn, in this current environment, we're facing a commodities bull market, higher energy costs, debts that are higher than ever before. So, how does the undersupply of energy and commodities really threaten the debt and the treasury markets? Do they really go hand in hand?
Well, so generally, if you have commodity undersupply, you're going to get inflation. And in a lower debt environment, you could raise rates and try to contain demand enough to rein that in. But because debts are so high, they have trouble raising rates to 3, 4, 5%, let alone 8, 9, 10% positive real levels. And so the combination of high debt and no longer having a commodity oversupply like we had for the past 5 years before the pandemic, that basically means that this is kind of getting mark to market now, right? So if you're a foreign entity and you're holding treasuries as your official reserve asset, those treasuries are buying you less energy every year compared to before, then they had relatively stable levels. And so it makes reserves less attractive. It makes people want to hold less cash and bonds. And it's led to a lot of speculation. I mean, part of why we had a speculative boom in the past couple of years is because there's so much money created. You had such deeply negative real yields that people went out and bought all sorts of malinvestments, right? So some of those made sense, but then other ones were things like Dogecoin, where people just piled into things like Dogecoin, and that's a representative of malinvestment. Same thing with some of the meme stocks and things like that. And so, it basically the market is not getting the right signals that it needs. And so I think that overall, the combination of that super high debt level, the super high, the constrained commodity situation, pretty much the only way it resolves in the long run is these deeply negative real yields. And unfortunately, in prior crack up booms of history or prior periods of inflation, usually speculation precedes them. It's kind of the early phases. It feels good to people, and they go out and speculate. And it's only on like the later part of it that it gets more challenging, because there are periods where the central bank fights back. And I'm not referring to this period as hyperinflationary, but even using an extreme example of Weimar, during that period, the central bank would try to fight back for periods of time. It wasn't like they were like, well, hyperinflation just happened one day. It was this multi-year process where they would say, okay, we're going to try to fix this now. And then, asset prices would collapse, and it looked like it was working, but then they'd run into an issue with people buying their debt, and they'd have to monetize again, and it just kind of breaks again. And so I think we're on kind of a slower, milder version of that, where you can get these periods of pushback to try to backstop the sovereign bond market and basically, make it good in real terms. But there's just, with so much debt in the system, that can't be sustained for long periods of time. So we dip back into, negative real levels. I think, the past decade was kind of characterized by, whenever they weren't stimulating, the kind of the fallback was low commodity prices, low economic growth, because that was the structural period we were in, a structural oversupply. And I think now it's the opposite, where the kind of default period is rising prices for a lot of things, commodity undersupply, and that, for periods of time they can push back. And the question just becomes, how long can they sustain that pushback each time?
So has the conflict in Ukraine and the sanctions that Russia has faced been the main cause of the skyrocketing prices of natural gas, for example, in Europe? Or was this a real theme before the war?
So this was a theme before the war. I mean, in late 2021, Europe's prices already looked like a Weimar chart. It already had that silly spike in up, and so that predated the war. The war has certainly added fuel to the fire there, because now there's more uncertainty around the ability to keep sourcing natural gas from Russia, both the desire to and Russia's ability to shut off certain countries if they don't meet certain standards. In addition, the broad oil markets are threat now, because now we have to, of course, add a risk premium to oil, because we don't know what's going to happen with a certain segment of supply. And then you have wheat exports and fertilizer exports from Russia and Ukraine that are more questionable now. Same thing with nickel, same thing with palladium. There's all sorts of Russia has a pretty large quorum of commodity production, a significant minority, like a significant meaningful chunk for multiple different commodity types. Mm-hmm. And so that, of course, that's not a non-factor. But it's not the originating factor, right? The amount of new currency creation was a big factor. The undersupply in capex, right? So the underinvestment in capex, that was a factor. But a lot of that predates the war, and the war just is another variable. And unfortunately, these things tend to happen in clusters, right? So in the 1930s, you had rising populism throughout the world, and that led to war in 1940s. And so we've kind of been in a similar environment where the 2010s had this rising populism, and that's been continuing into this decade, and now we're starting to get war. And basically, when the pie is not growing, when the economic pie is not growing, people are more likely to fight over remaining chunks of that economic pie. And of course, that makes the pie even more constrained because it's less efficient. Goods and services flow around less freely, and so these unfortunately tend to feed on themselves.
Mm-hmm. And as you're saying, it's feeding on itself. Just because Russia, let's say, is still exporting some of these commodities doesn't mean that anybody has the political will to or appetite to actually use some of those commodities from Russia either, right?
Yeah, and it depends on the market, right? So, and one observation I made early on is that most emerging markets don't have the luxury of deciding, we're not going to buy from this country, because in developed markets, you're generally more comfortable. You have more decisions to make about where you want to source things from. Whereas if you're in a country with 3,000 GDP per capita, and Russia commodities are on sale, they're going to buy them, and that's generally what we've seen so far. They've generally had a refusal to sanction Russia, a willingness to keep buying Russian commodities, because they don't really have a choice. I mean, if they don't secure their food and energy and raw materials, they can face revolutions, they can face riots, they can face starvation in a lot of those countries, which from their perspective are worse than supporting Russia. And so we've kind of seen this bifurcation in global markets where a number of countries, of course, have sanctioned Russia, but other ones have not. And so we've added friction and discounts to a segment of the world's commodities, but we've not really cut them off. But there's, it's harder in some cases for them to get there. It's harder for them to get insurance on their ships. They might have pipelines that don't go where they want to go. And so there are more frictions, of course, on getting them to where they want to be.
Right. So from your point of view, Lyn, has there been a push too quickly towards green energy sources and maybe an overly aggressive ESG mandate before these energy sources are really ready to provide countries with the energy that we are losing from the fossil fuel side of things?
I think that's a good way to describe it. I think that it's kind of like how in China you build ghost cities, right? And you get malinvestment because you have kind of top-down mandates to do certain things. I think we've seen kind of the ghost city theme in renewable energy in the Western world, where some of the investments we made were malinvestments. I think where you over invest in them, and then the technology and the market's not ready for it. So, for example, if you overbuild solar and wind, but you don't have storage, you get these periods of negative pricing, which basically means that energy is being supplied at a time when there's no demand for it, right? So, and that's just kind of, it gets curtailed or gets wasted. combined with the fact that they've disincentivized or mandated nuclear energy to come offline. And we've had that in the US. We've also, of course, had that in Europe, especially in Germany. I do think that this is contributing to the energy problem, right? I think that, over time, there are really interesting technologies that can diversify our energy sources. I think that solar and wind in the right locations, especially solar, can be useful. Their geothermal can be very useful. There's technologies that might be able to tap into deeper levels of geothermal to bring it to more places. There's all sorts of interesting technology around biofuels. I mean, there are interesting avenues to explore. But if they're kind of mandated to be put in place too quickly or incentivized through tax schemes to be put in place too quickly, and if other more reliable sources are banned or discouraged, that does come with a cost. And I think we are starting to see some of that cost now. I think nuclear, of course, played a big role. That kind of turning away from nuclear, that basically ultimately led to using more coal than we otherwise would have, ironically. And so I do think that some of these policies were not very well thought out. They were more political policies rather than engineering decisions, and not based on, what is the market kind of able to solve here? Like what, they look at an area and they say, okay, what is the cheapest, cleanest way to provide energy? That's not necessarily the answer we're going with. We're going with something that's kind of overlaid with kind of political decisions.
And feelings.
Feelings, basically.
Yeah. And it's an interesting point that you make about the move away from nuclear and, let's say, the spiking nature in some ways, I guess you could call it, of how wind power and solar is generated. Because, nuclear provides that baseload power, and maybe we could use solar and wind more strategically, hopefully, when the spikes on demand pick up during the day, right?
Yeah, that's the thing. So it's not just the amount of energy we produce, it's the amount of energy we produce at the time we need it.
Exactly.
And so solar, for example, obviously produces more at midday, whereas humans tend to use more energy in the evenings.
Mm-hmm.
And so unless you can take that energy and store it for a number of hours until the evening, some of that energy just gets wasted. They're literally trying to find a buyer and they're literally giving away for free or for even a negative cost because there's just not demand at that time. And so you can have an ironic problem where you don't have enough energy supply in the evening, but you're supplying too much during the day.
Mm-hmm.
And now maybe over time, there are some flexible sources of demand that can come in and eat some of that. I mean, ironically, Bitcoin miners have been around the margins, one of them, but there's also things like, choosing when to plug in your electric car. If everyone plugs in an electric car around midday, that's kind of a source of, storing it till when you need it. But right now, the demand side has more variable sources. The supply side has more variable sources than the demand side has variable demand for it. And so because we've been lopsided in that regard, we're not really bringing energy costs down. We're not even kind of keeping them level. They're going up in many places because we're having a mismatch. And some of that is based on these kind of misaligned incentives.
Mm-hmm.
And so baseload power or flexible power are a key part of making sure that there's energy, cheap and abundant at all times of day when you need it. And over time, there might be better storage technologies. I mean, people forget that, batteries they take metals, right? So all the battery technologies, if you were to apply them across all the grids in the world, that'd be a tremendous amount of resources. Copper, nickel, cobalt, all these different metals around the world would be heavily tapped by using those, and also by strengthening our grid. If we send less energy over pipelines and more energy over the grid, we need to basically strengthen our grid, which again is a lot of metal to do that. And so all of that is very resource intensive and ironically hydrocarbon intensive to get those metals out of the ground. And maybe in time there will be other ways of storing energy. I mean, there are, for example, you can do a hydro pump where you use electricity to pump water up to a higher level, and then when it runs down, it creates energy. There are kind of these non-battery ways to store energy, and maybe over time we'll get more efficient with those. But until those catch up, there's only so much of a percent of a grid that you can do with variable sources of electricity.
Mm-hmm. So, Lyn, do you see a time coming in the near future where we see a political shift back towards creating more fossil fuel production because of societal pressures of people not having enough energy? Or could this happen if the price of energy gets high enough to just incentivize those companies for a long enough time to invest in more capacity again?
So I think we see it in a jurisdiction by jurisdiction basis, and so a number of emerging markets have basically said, so we're shifting more towards energy security now, which is basically a polite way of saying we're going to do less ESG and we're going to make sure we get all the energy we need at all costs. And so especially places like India and China, they basically said, look, if we have to build coal plants, we will, because that's less problematic than just not having electricity for people. And it's unfortunate because coal is one of the dirtiest sources of energy, but that's what they have in that region. And so I think that we're already seeing it in a number of markets. I think we are starting to see some uptick in developed markets, where some of the politicians are not polling very well that have had these policies. And I think it's kind of this natural evolution over time where if people, if politicians do policies that the results of those start getting marked to market, right? So maybe in a cheap commodity environment, we didn't really see the ramifications of those policies, but now that we're in an expensive commodity environment, they're more apparent. And so if they are unable to solve those problems, they get voted out. They bring in another batch of politicians. We see if they can solve it. If they can't, they get voted out. It's usually multiple wrong answers until you get to the right answer. And I think that that's kind of the phase we're in, where we're going to have a lot of political turmoil until they start finding the right answer. And that's a process that can take years to change hearts and minds, as well as, let technology catch up a little bit.
Mm-hmm. So what do you think about the possibility that we're on the edge of an energy cliff, where we're at the beginning of a time where the energy return on investment is falling rather dramatically?
So that's partially a choice, right? I mean, humanity reached the highest level of energy density, energy return on investment, which would be nuclear, and we shied away from it over the past few decades. So we kind of, when we transitioned from biomass to coal to oil to natural gas to nuclear, we kept going up the chain of more and more energy return on investment. And it's kind of like we like Icarus, we flew too high, and then we just, for whatever reason, we just felt like we couldn't do it anymore. So we stepped back from that. And I think that, if we decide to invest in 21st century nuclear, right? So the three major nuclear disasters, even though they happened in different decades, they were all 1960s and 70s technology. They were all built around that era. And so there are 21st century technologies. One is that nuclear is already actually the cheapest, the safest form of energy, really, when you get down to it, even though the headlines don't always match that. But I think that 21st century technology can make that even better. Right. So I think that when we're not using this older technology and we're actually maybe make smaller plants and other things like that, that can be further improved. But whether or not we go down there is another question. I do think we're, yeah, go ahead.
Sorry, Lyn. I just wanted to add, and maybe, taking out some of the human element of running those plants. I know a lot of the contributing factors to those disasters were human error, right?
Yeah, automation can improve that, as well as the reactor type, and just have more R&D to figure out how to make better and better reactors. And so I think that we don't have to be at the end of our energy density, kind of evolution. So I think that that's partially a human decision. I do think that we might be reaching the maximum amount of oil we can pull out of the ground in a given year. That doesn't mean that we're running out of oil, but it just means that our ability to keep having more and more oil produced per year might be getting towards the end of its cycle. And so I actually do think that there are a number of challenges going forward about the ability to keep growing at the pace we have been, which is largely a result of energy. I mean, if you map human population, human lifespans, and things like that onto when we discovered fossil fuels and our energy production, it's pretty much the same chart. Basically, the past few hundred years, this whole industrial revolution really has been a result of us tapping into these dense energy sources. And I do think that going forward, that is going to be more challenging and less kind of easy than it has been for the past 200 years. But that's kind of a big picture view.
So as we think of the Fed's main tool of decreasing demand here, do you think that the main tool of fighting inflation is basically by decreasing demand. Do you think that commodities will have a material pullback because of this, or is there just not enough supply because of lack of investment for so long that prices need to remain high in most cases?
So I would be worried about some commodities in the autumn. I think once we get past maybe summer driving season, get past some China reopening, if they are still tightening and still trying to hold demand down, I do think you could get maybe a pullback or maybe like a like a stagnation, like it stops going up and those prices kind of chop sideways for a period of time. The way I've described it is I think this could be an inflationary decade, but not necessarily in a straight line. And just like I described before, even with Weimar, even the most inflationary periods, there are periods of attempted pushback, and so again, in a mild, like I'm not comparing this to Weimar, but in a milder sense, I think there will be periods of pushback, and so I think that looking back at the end of this decade, most commodity prices will be higher than they are now, but I do think that there are dangers of a handful of quarters in a row where you could have some pretty significant contractions or stagnations, and I'd be on the lookout for that maybe in the second half of this year.
So you say that the easiest way to navigate an uncertain monetary environment for the long run is through diversification and rebalancing. So does this mean that most investors need to be more nimble now than ever?
Either nimble or more diversified. So I think, a lot of investors assume incorrectly that the 60-40 portfolio is diversified because they own, say, 500 companies and then they own treasuries. Mm-hmm. The problem is that the vast majority of that asset mix benefits from disinflation and is hurt by inflation. Mm-hmm. And so I think the way to improve that is to have some equities, have some cash or bonds, but then also have some commodity exposure. And that can take different forms. That could be commodity producers. That can, in addition to be having some gold or Bitcoin in your portfolio, kind of these harder monies, these things that don't increase in supply at nearly the same pace. And I think that can, add a ballast to the other parts of the portfolio that generally benefit from compounding and disinflation. I also think that, history shows that in more inflationary decades, generally you get value outperformance compared to growth as a factor. And that's partially because the energy producers are generally in the value camp, commodity producers, right? So they're directly benefiting, but also usually when you have a regime change, right? So at the end of a very long disinflationary period, the stocks at the top of an index are very well adapted to that disinflationary environment, right? Mm-hmm. So these overpriced growth stocks that are kind of based on low interest rates, and when that starts to reverse, a lot of the things that were not adapted to that environment are undervalued, like energy companies, and a lot of things that are well adapted to that are overpriced, like growth companies. And we start to get that reversal. That can take years to play out, where you're both getting a valuation contraction and weaker performance from the growth equities, and you're getting a valuation expansion as well as good underlying performance from the value side. And so I do think that, again, there will be periods of reversal. But I do think that the value side of equities are a decent place to be this decade. So that includes energy producers, but also energy transporters that are less price sensitive for it, healthcare stocks, basically a lot of real world, low multiple, often dividend paying types of companies.
Mm-hmm. Lyn, can you explain to our listeners if gold's stock to flow ratio makes it easier to manipulate?
It does, because so if you have a low stock to flow ratio, like let's say oil, there's only so much storage in the world, and most of the output gets consumed as quickly as it's produced. And so there's no way to fake. I mean, my car is not going to run on paper claims for oil. I need the actual gasoline, mm-hmm. right? Whereas gold, a lot of investors are fine having basically a paper claim for gold. They don't need to consume gold. They don't need to consume physical gold. And so when you have something with a high stock to flow ratio where you consume a lot less of it than the amount it exists, it is easier to have, basically a large paper market, a large derivatives market based around that existing large storage amount. So you can have more claims for gold than there is gold. And as long as the majority of investors are fine with that arrangement, that can last for quite a long time. Now, every once in a while, that kind of breaks. Like you saw the failure of the London gold pool in the 60s, right? That system is not bulletproof, But yes, in general, high stock to flow ratio commodities are, easier to manipulate. Now, there are other factors like how easy is it to self-custody, right? So if anyone tried to self-custody large amounts of gold, it's obviously very challenging. It has challenges with portability, challenges with security, and that's why historically it got centralized in the first place, and that many people are just happy to have a derivative of gold rather than gold directly. So stock to flow ratio is not the only factor, but it's certainly one of the factors that can make it easier or harder to manipulate a certain commodity.
Mm-hmm. So, Lyn, do you prefer, or let's say, are there times where you prefer having derivatives of some of these commodities or metals, let's say by owning miners versus the physical commodity of gold, let's say, rather than other times?
I think it depends on the specific purpose you're going for. So, I think that self-custodied gold, silver, Bitcoin, things like that have a use because they're outside the financial system. You self-custody them. I think they're important. Now, if you want additional price exposure above and beyond the amount that you're willing to self-custody, that's where some of the derivatives can come in handy. And then also, the companies can provide some operational leverage on top of that. So, for example, if you expect a large increase in the price, something where they have fixed debt, they have fixed costs, but then they have variable upside, they can potentially do better than the underlying metal. Now, the challenge also is it depends on your view on what happens with energy. So, for example, if you expect gold to do well and energy not to do very well, then the miners would be very attractive places to be because their expenses are going to be relatively contained while their revenue is increasing.
Mm-hmm.
On the other hand, if you think that energy is going to go up as fast or faster than gold, you might be more cautious about the miners, and you might want to either hold the underlying, or you might want to look into the streaming and royalty companies that have most of that upside without really the variable expenses. And so it partially depends on someone's specific view on both the metal and the expense side on their best way to play it. And so I think that, obviously having physical gold in your possession is going to be a different risk and reward profile than having exposure to mining equities.
Mm-hmm.
So it really depends on what someone's trying to do with their view and with their reason for owning that in the first place.
Mm-hmm. Excellent, Lyn. Well, I think that's a pretty good place to wrap up today's conversation. Is there anything else you'd like to add or touch on before we do?
No, I think that covers it. I think that we're in this transition period where we have the first declining PMI cycle with rising inflation in modern history. We'd have to go back decades to find another one of those events. And so a lot of back tests over 20, 30 years are not going to be very informative for this type of environment. That's a challenging thing. You have to go back kind of longer to find similar periods. And I think it requires a degree of humility and data dependency because this is a very challenging environment. So everything's about probability assessment rather than certainty. And so I think that's how I approach things going forward.
And of course, I really urge our listeners to head over to your website, lynalden.com. And, for example, just read your newsletters. Your previous May newsletter has a lot of the issues that we talked about around inflation. You said you have to be very data dependent and very data heavy, and you do an excellent job of helping make sense of all that data. So I urge our listeners, if they have any interest, to go check out your website, lynalden.com. And of course, you're available on Twitter at Lyn Alden as well, right?
Yep, I appreciate that.
Excellent. Thanks so much for your time today, Lyn. Really appreciate it.
Me too.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.